All right. Good morning, everybody. So we made it to the other side. We have the NVIDIA earnings out, and since it's been pulling forward its earnings, and it's now running on like mid 2027 earnings, their uh, their inline earnings was not enough to pacify or satisfy. And that's why we're not really seeing much of an outcome. Throughout the morning, we could see the market shift its bias a little bit more, but at the moment, that's where we're sitting. We had comments out of Japan. They're likely to continue to cause some waves this morning. So the U.S. markets being led by small caps. We've seen this before where we get small caps dominant in the pre-market, then they take a back seat once the market opens and the other markets kind of come in and dominate. So I would look for that rotation. We are going to get some job numbers this morning. The data is not really far apart. So unless we get some surprise numbers, this shouldn't be too big of a deal. It's not the big job numbers that we're always on the hunt for, like non-farm payrolls, but any jobs data you want to pay particular attention to, and then keep an eye on how wide the forecast is. This isn't that bad, right? About 10,000 to give or take. We've got bigger data tomorrow that we need to focus on, even though those numbers really aren't far apart either. Still, PPI looming in front of us by the end of the week is something to be concerned with, especially for the idea of a hurry up and wait scenario. Um, the weekly expected move didn't indicate that we were going to get a hurry up and wait scenario. So at least last Friday, the market wasn't focused on PPI. But that's not to say that we won't see that sort of behavior today, anyways. Yesterday, we got that slow grind up, which I spoke about multiple times yesterday. I wasn't quite sure we was going to get it. It's really hard to call one of those in the pre-market. I didn't call it. I just mentioned it a few times. I thought yesterday would be a sideways day, which it was not, right? We just kept grinding higher and higher. But at least we had the backup theory, right? You got to plan and then identify if your plan is wrong, what the alternate theory is. I thought we would go sideways, and if that didn't work, that we would very likely grind. And oh boy, we just kept right on grinding. So hopefully that was enough of a warning to at least plant the seed or the idea that we could just keep on going. That way you didn't continue to try to short it as it just kept pushing. So tonight we'll get more data out of Japan. The data from last night was really, I think, the headline for the week. And I don't expect what we're going to get tonight to be nearly as impactful as what we got last night. Finance in Europe got kicked in the face. And that's going to be a concern as we get into U.S. markets today. Keep your eye on U.S. financials. We did start to see a shift in the Fed Watch tool yesterday. There had been some early forecasts of a rate cut into June, more into July, but June and July both had really started to highlight that cut. And then throughout the day yesterday, they were unwinding a lot of that, even while the market continued to grind higher. Now we can look at everything and see that it actually dropped back down again. So yesterday, this number was higher, but the day wasn't done, and we can see that the probability of a rate cut into July is actually higher again than a rate pause. It wasn't like that yesterday afternoon. As for June, however, not getting a cut is now above 50%. A week ago, it was in the 40s, and the probability of a cut was really close to 50%. So that's getting unwound a little bit. It's not aggressive, and that's kind of the point. When there's subtle shifts, 1 or 2 points up or down, it's not really a game changer. You want to look for significant, exaggerated changes. They won't be subtle. You shouldn't miss them. They should stand out. So just keep your eye on it, especially now we're done with NVIDIA. We're going to see the market really kind of digest that forward outlook and perhaps make a decision about how much more of that forward earnings they want to bring in. All right, the SPX closed at 69.37. My mouse is resting at 69.50. It's this bar here. Above that, 69.75. They're really close together in size, but 7,000 really stands out. It's going to be difficult for the market to even get there, let alone get above that, get on the other side of that. So 7,000 in the SPX still continues to be a massive ceiling that has no trapdoor in sight, no way to get through that at this point. Maybe as we get closer to OPEX, we could see some of this structure shift, but for the moment, we can't even anticipate any sort of magnetism or draw into that level because of the 69.50 and 69.75 levels that are in our way. To the downside, we still got structure at 6,800. So we're just trapped in this zone. I'm seeing a number of places calling for long opportunities in software names. And it makes sense because they've fallen a long ways. The put call ratios and implied volatilities and distance traveled, rate of change. There's all these things that say, oh, wow, they've fallen so far. They're very likely going to dead cat bounce or get some knee jerk reaction to the upside. Yeah, probably. Just keep in mind that what caused them to roll out of bed in the first place isn't going away, and that this is very likely just a rally into resistance before it rolls over and continues to make new lows. And all of those articles out there are just talking their book. They need somebody to buy what they're trying to sell, right? So, of course, they're jumping up and down and suggesting that everybody should buy the dip so that they can unload what they're holding onto you. Risk out of the White House is really light. Really not expecting anything out of that. So I think the big thing right now this morning is keep your eye on those financials. The call wall rolled back down again, so it just continues to shift high to low, high to low. For some reason, it's not showing up, so let me just re-roll it. There it is. So call wall 7011 cog line, put wall 6811 cog line. Volatility trigger 0 gamma. You can see that we're above both of those levels. We're also above the 3-day, the 3-week, 20-day, 10-day, 10-week. We're above everything, right? We just need to keep it. Overnight volume sitting at 53,000. That's the lightest it's been for quite a while. But that's what our average is, sitting in the mid 50s, is just showing that typical overnight participation. It's exactly what we would want to see. So nothing really standing out in that. We finally got out of the box that we've been focused on. There's that slow grind that I was talking about, but really a large part of it came at the end of the day, right? That extra push. Still, by the end of the day, we had reached above 69.50 and gotten into 69.60 by 4 o'clock. So we had firmly escaped the box and had already pushed significantly. So now we got to figure out what's coming next, right? We've got this zone. This is what we've already marked out. There's the midpoint. We've been coming back and forth through that midpoint level. So now we've finally cut through. The focus now is, what are we going to do with this? It's not a lower high yet. It's kind of a big deal. We don't know what we have yet. So marking out that high, we got the lower high here. We have an unknown here. If we drop back down, cross that midpoint and close somewhere down here, then yes, this will be a lower high. But if we close inside of yesterday's range and or above 6,900, then we can't count that as a lower high yet. We won't be able to count it as anything because we'll still be working right here digesting that. We've got our low here, which is the higher low from, the Feb 6 to Feb 17. So there's a higher low. We'll have to see how we deal with this. If we come down, stop somewhere in here, then all of this kind of gets put in as a higher low. But if today we break yesterday's high and continue to the upside, then we'll be looking at this previous high here and seeing whether or not we're going to get a matching high or a newer high, a higher high. So all of this needs to be resolved is kind of the takeaway. It's a lot of trash. It's not really very clear. Big wicks all over the place, both directions. There's no dominance. And that's a big warning for swing trading in general, right? If you don't have any directional bias in the indices, the heck are you going to do with the markets that follow the indices? And, 60 to 80% of the market does what the indexes do. So if we got nothing here, no confidence, no bias, no direction, we don't really have much out there either. We did get a 310 surge, so it's a bull surge. But the fact that we'd already spaghettied everything and we have the moving averages all tangled up kind of takes some of the juice away from that. Bull surge is when price crosses through the 3 and the 10 and then escapes above the 10 high enough, far enough, fast enough that it drags the 3 through the 10 and we get both. So we got the price and the 3 both through the 10, and we got to stay far enough away from the 10 to continue to drag that 3 above the 10 higher and higher. Looks a bit like this here, where price crossed through the 3 and the 10 and then stayed far enough away from the 10 to keep that 3 expanding farther away from the 10. It's a bull surge. The ADR expanded back to 100. It was down to 96 or 98 earlier this week. That makes sense though, because we're finally getting out of the range and beginning to expand, and that's going to expand our average daily range. We don't have any edge at the moment for hitting one side or the other. We're stuck in this box, so we got to get the heck out, right? Get out of this box and we can challenge 70.15. Get out of the bottom and we've got 69.15. It's a 100-point range because it's a 100-point ADR. Since we're basically sitting in the middle of it, we don't have any edge to go to one side or the other. We did make it all the way through the day yesterday without hitting that pivot point. So that's a single count MDP we've already hit today, which is why yesterday's is a single count. Generally, what we would look for on a reversal from the lows, which, we wasn't at the lows, it kind of takes some of it away too, is after we get a nice reversal and we're looking for a run back up, you can see days of run to the upside, is that we would want to continue to outrun that daily floor pivot. Staying above it really highlights the aggressive push for a reversal with strength that's running back up to the previous high. There's some flaws with that logic for what we were dealing with because we wasn't at the low when we started this push to the upside. So yes, yesterday we had an MDP, but it wasn't from the lows. And today we've already interacted with our daily floor pivot. So as much as yesterday was a solid drive to the upside, it didn't get far enough away from the new floor pivot, and we've already interacted with it. So it's not to say that we can't continue to go up, just that we won't be doing it with the validation of missed daily pivots being left in our wake. We're back above the weekly pivot. That puts us in a bullish posture. And we're interacting with our daily floor pivot. So we're basically in the center of the basketball court. From here, we could move up 1.5%. We could move down 1.5%. And it wouldn't even be considered overbought or oversold at that point. We have a wide channel today. Wide channels imply that we shouldn't break out, or if we do break out, that it fails and we come back in again. We had a wide channel yesterday, and that didn't help us any. Just keep in mind that these channels, they don't make price do anything. They're just giving us some insight on what to expect out of price today. So we're still inside that channel, or at least struggling to get outside of it. If we actually do get outside of that channel, we got the SNR lines to focus on. 70.15 and 69.15 is where the ADR half is at. The SNR lines are front running that. So 70.08 for the resistance level and 69.17 for the support level. We'd have to get through those to get to the ADR half for today. It's not much. And path of least resistance, the indicator is suggesting that going up is more likely than going down. You can see the distance to R1 is a lot farther away than the distance to S1. But again, these pivots and their SNR levels, they don't make price do anything. All right, we're working on our third distribution for the week. We've got an old point of control from a few weeks back. We interacted with that yesterday afternoon. And you can see we left very little up there. Now we're sitting in this zone that we've developed in the Globex, building out the third distribution on the week. We are outside the value area. I wouldn't be surprised if we drop back down and test the value area high, which is S1. We were just looking at it, right? 69.17 is S1. ADR half is just below that, 69.15. So that's 3 levels of support underneath us. And then, of course, we get into the footprint, this high volume node, and the point of control. This other structure back here expands all the way up to 7,000. So even if we can get through that point of control, which is a big if, it's going to be a fight all the way up to get to the top of this box. And then we've got the value area high at 70.07. And another footprint back here, which we wasn't able to get through the last time we double tapped it. All things considered, we've got a relatively good gift this morning. This is our own Globex. Real simple. Get out of that box if you want to do anything else. Break out of it to the upside. You can challenge yesterday's high, and then we'll aim for 7,000 and then 70.50. Lots of structure overhead, lots of resistance we'd have to work through, but that would be the idea, right? Break out of this, challenge yesterday's high, aim for 50s and round numbers, and run it, right? To the downside, once we get through our own Globex midpoint, cut the mid, drop through the bottom, challenge the RTH of yesterday. That's the RTH low. Get through that, and then we can challenge yesterday's real low. And yesterday's midpoint. So level by level. I would focus on last week's high too. That was a level that we interacted with multiple times yesterday. That lines up really good with yesterday's RTH low. That was the validation that we got yesterday that told me we were going to continue to grind to the upside when we got that Busby after the week breakout. So, all things considered, it's a really nice setup for the day. With yesterday's large expansion day, once we get below 69.32 cog line, then we should have a straight shot back down to 6,900 and then, of course, 68.50, running 50s back the other direction. And to the upside, well, we've already laid those levels out too. Just got to get out of today's Globex box. All right, we finally are working on the last bit of those candles, but since we did break to the upside, we're putting in new footprints. All right, so we're not going to narrow up as we had anticipated since we're back up in that same level again. This very likely is going to move the point of control up 100 points from 68.60 to 69.60. It's not going to happen in a single day, but that's what I would expect by the end of next week. That would get us close to when we should start seeing them reprice for OPEX. I think it might be a little early. We'll have to see how long it takes for us to build out the level and bring the point of control up. Otherwise, it's thin across the top. And then, of course, we got all of this development underneath us. Well, you can see the work that we put in yesterday afternoon between 2 and 4. It was enough to bring the point of control up. So that's the area that we're struggling with this morning. Not to the tick, but that entire zone. So we're not just really dealing with our Globex high, we're dealing with yesterday's RTH high. I know it spiked up, but I would focus on this zone where the point of control is. Because if we look at this tail up here, or this little trapdoor, there's not a lot to it. I don't think it's going to give us much trouble. It's this area that we're really struggling with. No VPOC today. We've already cut through that level multiple times, and there's nothing showing up in today's distribution that really highlights anything either. All right, we're through last week's close. That's the gray line here. We want to focus on yesterday for a number of reasons, right? One, we're on the upper half of the week. That's positive. That's a good thing. We're outside of last week's high, so that's a good thing. We're talking about, closing higher than last week's high. That's considered bullish. But we got to keep this momentum going. Otherwise, we're likely to fall right back down inside that box again. So yesterday's midpoint is a level we want to stay above. 69.40 is an old school cog line. We don't really use it anymore, but I still remember it. It's been a lot of work on those 40s. Stay in the upper half of this candle's zone and or get outside of it to the upside and look to challenge that 70.35 or 70.36 up here. That's the week's expected move high. We're doing good so far. There's nothing wrong with this. The main thing to remember is that we've been in this range forever. And we're still in it. We're still just spinning our wheels. So we got to get out of this. And NVIDIA was not the catalyst. It was not the trigger that's going to get it done. We're going to need something else. We are above the 10-day more than 0.5%, so that's a good start. We're not overbought as much as yesterday may seem like we traveled a long ways. We didn't travel too far. It wasn't too fast, and it doesn't owe us any pullback or mean reversion simply because of how far we did move. Looking at the week, same thing. We're above the half, but that's about it. So we're more than 0.5% away from the 10-week. That is not overbought. It's not overextended. There's nothing wrong here. We're just in a good, healthy spot. Now, I've been looking for this crossover for a long time. You can see this steady progression of lower highs. At some point, we're going to break over. Maybe this is the month, right? March. February's done. So getting above the 10-week by 2.5 or 3% would require us to move farther than the 10-week moves on a week-to-week basis, and after having already moved that far, move another 2.5% past that. We don't have it. That would require a significant amount of fuel. Whatever that trigger is, it's very likely the same trigger that's going to have to get us outside of this range that we haven't been able to break. And if you buy the dip in software, just be nimble, right? Don't hang on as if it's some long-term recovery trade in software, because a lot of those software companies aren't going to recover. They're just slowly going to be destroyed until there's nothing left. Looking at what's down this morning, Bitcoin, energy, China, more China. Communications is down a little bit, not enough. Expanded tech through IGV is also down, but not enough. Gold miners, same thing. Junior miners, Mag 7, cloud computing, all of those are down, but the benchmark we use is 0.5%, and these are not down 0.5%. Uranium, communications, all of them. So keep your eye on them, see if they continue to stay weak and go down more, or if they're finding a floor, building some stability, and maybe even moving to the upside. So on the one hand, if you're looking for an upside breakout and a continuation of yesterday's push, you kind of need these. Keep your eye on them, expect them to turn green to get that rally in the S&P and the NASDAQ. I would add to it, where's the chips, right? You got to have chips with your dip. If there's no chips in there, you're very likely not going to get that rally either. The sectors that we need for a rally: tech, finance, consumer discretionary. It doesn't have to be all three. You can mix and match those as you please. And tech is really generic, so we can replace, quote, tech with something more specific like cloud computing, software, uh, chips. You can really just kind of hone into a specific area. Communications. We need something if we're going to get that breakout. Now, all of this leans towards a market breadth and a backdrop of a rising tide. But really, we can break out and run even without that. We just need 0-day flows. Yeah, it's the pre-market. We don't have 0-day flows. We don't have any flows in the options at this point. So if we're going to rally because of that, we have to wait until the market opens. So we don't have any way to validate some sort of pre-market 0-day opportunity. Something else that could cause us to break out and rally, if it's not going to be breadth, would be a focus on dollar bond yields, looking in that direction. And if it's not FX markets, then commodities could do it. We don't have any of that this morning. So if we're going to get a breakout that leads us higher, what we have now would need to change. We'd have to unwind a lot of this and bring in the A team, the green team, to get that push. Looking at what is up this morning, we got quantum, which is, it's about like that UFO that we was looking at yesterday. Risk, low float. Well, I don't. There's some big names in quantum, right? Like Honeywell, and of course, a lot of the Mag 7 is invested in quantum. So I'd have to open that ETF and see who's dominant in there. But quantum is up this morning. Emerging markets, but not enough. Industrials, but not enough. Financials. Remember, Europe's financials got kicked in the face last night. So keep your eye on financials this morning. See if we lose those. Chips are also green, just not enough. It's a recurring theme this morning. Might as well just label the entire briefing, it's not enough. That's what we got. A whole lot of a little bit. It's a poquito. So at least we'll see it coming, right? If we get that breakout started, get through the Globex high, challenge yesterday's high, we just want to start asking the question, what's giving us the lift? Commodities, FX markets, 0-day flows from dealer positioning, what, right? Once we identify the what for the push, then we know what to monitor and keep track of to see if that push is going to keep coming or if it's going to dry up and stall out. Keep your eye on the clock. Watch headlines. We don't have an economic event today that is big enough, I think, to cause the spark that we're looking for. The little bit of jobs data that we're supposed to get today should not be a large enough catalyst to get us out of this box. But markets have reacted to less. So who knows, right? Keep your eye on the clock. Be careful. Be safe. I'll see y'all tomorrow.